Hello, welcome to this Ned Davis research video where we will help you see the signals. My name is Brian Sanborn, NDR's Global Head of Investment Solutions. In this episode, we will be joined by NDR's Chief Economist, Alejandra Grindal. 'Tis the season for yearly outlooks. Alejandra, can you provide your view on the global economy for 2024?
Hey, Brian, I would absolutely love to. So as we move into 2024, we expect that many of the downside factors that affected the second half of 2023, where we saw slower global growth, we just expect them to persist. As a result, we estimate a 2.7% real GDP growth in the global economy in 2024. This is slightly less than what's likely going to be a 2.9% growth rate this year. To give you some context, historically, global growth rates under 2.5% have been associated with severe global recession. So this ultimately means that our base case is not for recession, but as you can tell, we're likely cutting it close. So we just would not underestimate the risk of one happening. And we assign about a 35% probability of global recession next year. So less likely than likely, but still, something we need to be watching. And this is important because, pretty much all severe global recessions have been associated with the worst equity bear markets. Our global recession probability model remains in the low risk zone. So this is actually some good news, sort of pointing to that soft landing scenario. However, you will notice that the model has picked up slightly over the past couple of months. This could potentially mark a turning point in 2024. Again, we don't expect that severe recession risk to be our base case scenario, but it could lead to potentially greater volatility in equities next year.
So given the market's current and continued focus on inflation, where do you see its trajectory in 2024?
Yeah, again, one of the hottest questions. And, if you actually just look at what's happened over the past year or so, global CPI growth has actually fallen by nearly half since its peak around late last year. And so that's some pretty good news. We've seen the elimination of COVID imbalances, easing global supply chain pressures, again, associated with the pandemic. And ultimately, this has led to quite a bit of significant goods disinflation. And we expect that to continue through next year. A lot of our leading indicators are pointing to that. But a lot of the easy work has been done, and some elements of inflation, particularly if we look at services, are just having a harder time coming down, due in part to tight labor markets and this continuation of high wage growth, not only in the United States, but a lot of other parts of the developed world. And then we can't forget geopolitical tensions, including this ongoing conflict in the Middle East. This could also present upside risk to commodity prices. And again, we know what that did to inflation in 2022. Another thing to keep in mind is some economies have very specific concerns. So for example, in Europe, they face pretty elevated unit labor costs. In the United States, stubbornly high shelter prices are, keeping that services inflation a little higher too. I would say the bottom line is that the inflation path is moving in the right direction, but rates are likely to remain above central bank targets, especially in those major developed economies, by the end of 2024. And then another thing I want to point out too, because I think this is also the key question, is what's the long-term story? So if you think about many of the key disinflationary factors prior to the pandemic, they may no longer be quite as strong. So, it is worth pointing out that some positive factors remain intact. Technology, for example, you could argue its disinflationary effect has been amplified and could be even more so later in this decade. So ultimately, this argues against inflation, say, going back to those peak 2022 levels. But if you look at other factors such as less globalization, which has happened by, mildly or gradually reducing ties with China, as well as with its allies. I talked about demographics and weak labor supply, and then just this possibility of ingrained higher inflation expectations. We've had high inflation for a long period of time and, gets into our heads and becomes a self-fulfilling prophecy. Ultimately, this just suggests a greater inflation rate compared to the post-global financial crisis era.
And finally, what are your expectations by region for next year?
Oh, yeah. I mean, ultimately, that plays into that global growth story. So, for the US economy, we expect a growth rate of somewhere between 1 to 1.5%. So, ultimately, that does imply that we see a soft landing in the US economy, that the US economy will avoid recession next year. And this is important because this is actually a key criterion for keeping the global economy out of recession. That old adage, if the US sneezes, the rest of the world catches a cold, that is 100% true. The resiliency of the consumer and the US job market will really ultimately determine whether the economy succumbs to recession. So, very data dependent. China is also a very important economy to watch. It's the world's second largest, typically the largest contributor to global growth. We expect economic growth to ease to a 4.5% expansion in 2024, so slightly less likely than what we'll see this year, but still enough to contribute quite a bit to global growth. Weak sentiment, along with the ongoing property crisis, will prevent growth from exceeding this expectation. Fiscal stimulus will probably remain modest. The government doesn't want to stoke excesses and bubbles. And then also, one thing we've written about quite a bit is persistently high debt and weak demographics also suggests that stimulus just may not be as effective as it was in the past. If I could maybe point out one potential upside surprise, it could come with a large fiscal package geared toward households. Again, no clear signs of this, but something we'll be watching. But it is important to note that potential growth is likely to head lower in the coming decades just due to waning demographic and productivity trends. The good news is other emerging markets have actually been far more resilient. So India, for example, which, according to at least our metrics, is the world's fifth largest economy, it's seen pretty broad-based gains in economic activity and touts a pretty robust secular path. Europe, however, has a pretty decent chance of falling into recession if it actually hasn't entered one already. Our Eurozone Recession Watch report is showing 5 of its 8 indicators at the critical recession level. This is sort of on the cusp of indicating recession in the region. The good news, at least, is most Eurozone data has stabilized at low levels. So ultimately what this means is if the region does slip into recession, it's likely to be a mild one. Another thing I always like to note, too, is that the Eurozone's economic potential, so its best long-term GDP growth given its inputs, is quite low. So it also means that it doesn't take much to put economic growth into negative territory.
Alejandra, thank you very much for your insights. NDR clients can read Alejandra's research notes in her weekly Global Economic Focus publication. The indicators Alejandra and the research team developed for our subscription service are also used in our model portfolios, which are available for direct delivery on TAMPs and through ETFs. For more information on NDR, we encourage you to visit the following websites. Thank you for joining us as we help you to see the signals. So long.